If you've liked the UNH thesis, you will love Elevance Health. I'm Mehdi for Tokyo Alpha Mind, and today we are going to deep dive into the latest earnings, the business, and the investment thesis for Elevance Health, and we will see if it's actually a better investment than UNH at the moment, and if it should be in your portfolio. So let's get started. First, what's the business of Elevance Health? Elevance Health is actually the second for-profit health insurer in the US after UNH, and if you looked at my previous UNH video, you will understand what's the business of this type of companies. So I will just put the link out there. Elevance Health is actually an insurer, health insurer, and they have actually two main segments very similar to what we are seeing with UNH. So with their health insurance and with their care loan. So basically, all the health services that they have complementary to the health insurance business. So basically, it is actually a very similar model to what we have seen with UNH, with the same strength and the same weaknesses as UNH. But something which is maybe more interesting and that we are going to see in the following chart is that they have a different mix in terms of insurances and in terms of population that they are insuring. But first, let's have a reminder of the four type of plans that Elevance Health and UNH insurers are actually providing into the market. So I think that in order to understand the business, you need to understand these four types of insurance plans. So first, you have the commercial plans. So basically, which is when Elevance Health has actually a deal with some employers and they provide health insurance through the company. I think that this is very widespread. Then you have Medicare or Medicare Advantage. So this is basically health insurance for senior people, so above 65. And then you have Medicaid, which is basically actually Obamacare. So this is health insurance, but for lower income populations. And then you have what we call ACA, which is basically health insurance, but for individuals or like freelancers, for example. And this is one of the markets that has become very popular among retail investors, especially due to Oscar. So basically, these are the four plans that you have to remember. So commercial, Medicare, Medicaid, and ACA. And so if you understand that, then you will see on the next slide that basically we can see that as well as UNH, Elevance Health has a very diversified portfolio of health insurance and basically customers that they have. And so that's actually one of the key strengths from Elevance Health. One key difference with UNH is that the mix is slightly different and that Elevance Health has a much more broader portfolio of insurance for commercial, which is actually quite a strength because this is where they can reprice much more easily. Why? Because this is very important to understand, is that commercial is much easier to reprice because Medicare and ACA and Medicaid, they are actually negotiated with the state or even the federal government level. So that's why it's very difficult to reprice, and that's why a lot of insurers have a lot of difficulties to actually reprice it very quickly after they have seen such a high loss ratio. But for Elevance Health, so what we have today actually is even worse than UNH because their loss ratio today is around 90%. So that's why in the past few quarters, like they have been actually hit very hard in terms of profitability. So just to refocus on Elevance Health, so basically we are seeing that the core holdings in terms of insurance and the core proposition from Elevance Health is basically commercial. And then we have a lot of Medicaid, so lower income population. We have a little bit of ACA and a little bit of Medicare. And so one of the key factors that is going to help actually Elevance Health to come back to profitability is basically renegotiation into Medicare, Medicaid, and commercial. So now that we understand the mix of the product of Elevance Health and how it is different from other insurers, so we are going to be able to see how their latest earnings is going to impact the future and what if it's going to be a great investment going forward. But first, let's review their Q2 earnings, where they actually showed very bad numbers, to be honest. But thanks to their CEO, they kind of saved the day and they explained that yes, the figures were not very good, but going forward, they're going to be able to reprice all the different plans, and they're going to reprice it actually by double digit, like 20 or even 30%. And so what we can expect from Elevance Health and their Q2 earnings is that this was actually a bottom in terms of profitability, and going forward, everything is going to be better. But first, let's review these Q2 earnings. First thing is the results by themselves. So what we are seeing is that, well, first, the operating revenue grew by more than 14% to $49 billion. But I think the biggest detrimental factors was that medical loss ratio was around 89%, and it increased by 260 bips, which actually pretty bad, given that actually the norm is around 80%. And so basically, so they reported an adjusted diluted EPS of $8.84 per share, and which is actually below analyst expectation. And I think that's why Elevance Health actually took a hit, especially initially after reporting these figures. But the other very important thing that they reported during Q2 2025 was that they revised downwards their guidance. I think that's why actually shook the market a little bit, and they revised their guidance to a fully adjusted EPS of $30 per share. And so actually this reflects a lot of cost and higher medical loss ratio that they anticipated. But basically they actually owned it. They say like, yes, like the plans were mispriced, very similar to UNH, very similar to a lot of different insurers, and that they're going to work forward to actually reprice a lot of different plans. And so basically, like the whole story around their Q2 2025 earnings was that, yes, very similarly to UNH, the whole industry kind of messed up a little bit, and that they have mispriced the fact that people used, we had much more usage of the different plans from a lot of different populations. And so basically, what's going to happen going forward, and this is what we have to focus on. Basically, they are going to work first on the repricing of their different plans. So as we've seen previously, so they have a mix of plans of commercial, Medicare, ACA, and Medicaid. So on the commercial side, they're going to work with employers, and they are going to explain them that like they have to reprice a lot of different plans because these plans are not profitable anymore for any insurers. So basically, so what we're going to see is a lot of negotiation with employers, and I think that this is going to actually go very well, because I think that employers don't really have a choice because everybody is going to raise the prices. Then we get into the federal and the government basically subsidies for all these different Medicare, Medicaid, and ACA plans. And so this is going to take maybe a little bit more time. Maybe it's going to be a little bit more difficult to actually reprice these different plans higher. But what we are going to see is that because the whole industry is going to have to reprice these plans, because we are going to see much higher medical loss ratio across all insurers, the prices, they are going to increase, definitely. And so which means that it's going to become, or it's going to be more revenue for Elevance Health, definitely. So we are going to see the revenue grow in the coming years thanks to this repricing, but we are going to see also margins definitely improve, and this is what they are targeting. And on top of all this repricing in Medicare, in Medicaid, and in ACA, we are also seeing that a change of strategy in terms of the plans that they are targeting. So for example, on the Medicaid side, they want to actually focus on much more profitable plans, especially like the dual plans that they are actually seeing. So what are these dual plans? For people who don't know, is basically people who are on Medicaid and on Medicare, so people with low income but also above 65. And so basically, usually these plans, they are actually much they incur more costs, but they also give they receive more subsidies, so they are a bit more profitable for insurers. And on top of that, Elevance Health is going to exit some non-profitable market, especially on the Medicare side, where there is definitely just too much cost and it's difficult to reprice everything. And so what we are going to see is that going forward, so in 2026, basically Elevance Health, they have said, and they are going to do it, they are going to reposition themselves to improve their margins. This is what we're going to see normally translated into their earnings. And added to all this repositioning and this repricing, so we are going to see also Elevance Health, just like UNH, try to capitalize even more on their care loan basically services, and to try to actually leverage even more the health service that they have, and basically replay or reuse the whole UNH playbook. And we are going to see profitability and margins definitely improve going forward, and this is going to be a very positive for Elevance Health. Now, if we look at the valuation of Elevance Health, so compared to UNH, is actually much better, and we're going to see that this is one key point in terms of the takeaway and the investment thesis for Elevance Health. But let's look at the figure done by in terms of trailing valuation. So what we are seeing for basically Elevance Health is that a P ratio of 13.5, EV to EBITDA around 10, and basically price to free cash flow of around 13.8. So what we are seeing is that actually Elevance Health on the trailing 12-month basis is actually pretty cheap. And it's even cheaper if we actually project that into the future. So we have a P ratio of 10.3, and we have actually EV to EBITDA of 8 and price to free cash flow around 10.5 if we look at this fiscal.ai projection in terms of valuation. So beyond the figure, I think that these figures are sometimes a bit misleading, because like if we look at the EPS reported by Elevance, it's not always very clear. So what's the right multiple and what is the right EPS to use, because they have an EPS and a fully adjusted EPS. But the point here is that basically today Elevance Health is actually quite cheap, and it's cheaper definitely than UNH. And given that the fact that they have very similar business model, they have a very similar investment thesis basically in terms of repricing in 2026 and 2027, that's why I think that, and we are going to take away and investment thesis, that Elevance Health is actually a much better deal than UNH currently today at the moment. So I'm specifying today at the moment because UNH at 250 is different than UNH at 350, definitely. Basically, we have seen UNH get revalued much more aggressively than Elevance Health, definitely. So Elevance has not recovered yet, and I think that people are kind of sleeping a little bit on Elevance Health because the investment thesis compared to UNH is actually very similar. It's actually a copy-paste, it's basically the same. And I would even say that the thesis for Elevance Health is even better because they don't have a DOJ investigation, they don't have like a change of management. And what we have seen with the management of Elevance Health is that it was actually fairly transparent and it was pretty strong. So what we can see with Elevance Health is that this is a very similar story to UNH once again, but it's even a stronger story and a simpler story. And which means that if you like UNH, you will love Elevance Health, definitely. And in terms of repricing, so we can even hope that with the negotiation, so with the government for the basically the repricing of Medicare and Medicaid, like they will benefit even more, and they should actually come back to better margin even faster than UNH. And that's why that today, given that the fact that they are still pretty undervalued, so what we have seen is that a very cheap valuation for Elevance Health, and they have a huge potential for repricing and improvement of the margin. I think that Elevance Health today is actually a wonderful opportunity for actually any investors. This is not financial advice. I think that every investor should actually deep dive into Elevance Health to look at the opportunity that we have today. But definitely in terms of EPS, and if we follow their guidance, so the EPS should actually grow by 12% going forward. So basically in the next 3 or 5 years, 12% CAGR, and which is actually double digit for growth in terms of EPS. And if we compound that to basically like a revaluation or valuation expansion that we will definitely see if we actually have these figures in terms of EPS, then definitely you can have a double, I think, in the next 3 to 5 years with Elevance Health. So that, as I said before, it's not financial advice. Do your own due diligence. If you're interested in other analysis like this one, so please like this video. Please tell me in the comments what do you think about Elevance Health as well, and please subscribe if you want more videos like this one. And I see you in another one. Bye.